All right, thank you very much. Okay, today I have a quick session where we're going to look at the conclusion of IAS 12. All right. Not too long ago, we started to look at IAS 12. I'm just going to quickly revise a few things for the sake of those, who didn't pick up one or two things that we said in that class. All right. Just let me set this up. Fantastic. So we said there are two major parts of this standard. There is one called the deferred tax, and there's another one called the current tax. The current tax being the first that we considered, because like I made mention of in that class, was quite straightforward and easy to pick. All right. We said that current tax would refer to any previous liability plus your current estimate of tax in the current period. So your current tax will cover any such tax liability or assets that will accrue, that would have accrued from either previous periods or even in your current period. So it's just, let us make it simple. It means that we are looking at the tax liability that you now owe. It's the accumulation of whether you have owed it in the past or you are owing it as a result of your transaction or activities in the current period. So that would be income tax, current income tax rather, or current tax as the standard puts it. And quickly, it was imperative that we quickly consider some of these definitions. Accounting profit. Of course, you would have determined your accounting profit, making use of your accounting principles, your standards, and the likes. All right. And that is what you will find in the financial statement, specifically speaking to the statement of profit or loss and OCI of a company. So either it's a profit or it's a loss. Then we have what we call the taxable profit or tax loss. And we said that that is what the taxman or the tax authority is attributing to income tax. So upon the taxable profit, that is when we are now going to calculate the tax that is supposed to be paid. Now, accountants will try as much as we can to imitate this process, meaning that we'll try as much as we can to using the existing tax laws to try and come to an amount that is very, very probable. You understand? That is probable that that is the amount that will be paying for tax as a result of past periods and in the current period. All right. So that is taxable profits. And then we come down to tax expense or incomes. Of course, when you are doing your determining your profit or loss, you would have estimated your expenses using accounting standards or principles. And in doing that, you would not have paid attention to cash basis at all. But from the length of what we have even studied so far in this topic, we have seen that there could be situations where we treated some examples like that, where the tax authority will say this will be allowable only on cash basis, meaning that some of the deductions you made from your incomes in the name of expenses, some of them will have to be added back to the income on the basis that you had not spent money, you had not spent cash on those expenses. What you have only done is that you accrued those expenses. So on that basis, we may find a situation where the tax authority will say, we need to help you recalculate for the purpose of taxation. We will need to recalculate your, what is it called now? We will need to recalculate your taxable profit by determining what are the taxable expenses and what are the taxable incomes as well. All right. Now, away from that, we went on to talk about recognition of current tax assets and liabilities. And one thing we said was that it is possible to offset any recoverable tax deduction from your liabilities. We looked at that, we solved an example like that, and then we went on to measurement. And we said we could have exception. And what are those exceptions? When taxes arise from a business combination, which is an acquisition, it will be treated differently. Of course, it will be treated differently in your slightly different from the way the tax IAS 12 puts it. When you are doing your consolidated account, all you do is just to add up those the tax of the parent and that of the subsidiary without having to do a working for what is really the tax due for the group. All right, tax arising from a transaction or event which is recognized directly in equity in the same or different periods. All right. We went on to presentation. Like I said, presentation will be that your tax asset is showing separately from your tax liability. But the standard is not against set-offs. You can have set-off. And we said it's that the same condition that IAS 1 gave for set-offs is the same condition that applies to current tax assets and current tax liability. IAS 1 gave two conditions. It says the entity must have a legally enforceable right to set off the recognized amount. And in terms of legally enforceable right, you will find out that in the way tax laws work, at least if I don't know for another country, I know for Nigeria, that you are allowed to make, for instance, tax credit withdrawals from your liability. Deductions from your liability. Meaning if you have a tax credit, you are allowed to make that deduction, especially in the case of, for instance, withholding tax. Withholding tax is usually an advance payment. It's treated as an advance payment. So when you come down to your company income tax liability, whatever is your withholding tax asset that has been remitted in your name, you are allowed to make such deduction. So that means in terms of withholding tax credits, the number one condition, legally enforceable, it goes. You are well on point. And then in terms of the second, I said the entity intends to settle the amounts on a net basis or to realize the assets and settle the liability at the same time. That is also very straightforward. We want to settle on a net. Of course, that is exactly what we want to do. So current tax in terms of presentation allows set-off. And I'm only trying to bring you that there is uniformity in the standards. You see that the same conditions that applies to set-off generally in IAS 1 or conceptual framework is the same principle that comes into IAS 12. All right, quickly, deferred tax. We said deferred tax. I think one of the things I try to emphasize as much as possible is for you to first of all note that this deferred tax is not a tax that federal government has levied on you, or state government or any tax authority has levied on you. The tax authority does not levy deferred tax on you. They are not in the business of deferred tax. They are not at all in the business of deferred tax. However, deferred tax itself is an accounting estimate that you are making now for future tax consequences. For future tax consequences. Meaning that like we said in the last class, you may find out that the basis upon which the tax authority is taxing you now, there will be an event in the future that will trigger them to still tax you on the same transaction in the future, meaning that a transaction occurred in the current period. However, the full tax effect will not come and take place in this current period. Probably because, or it's not even probably, usually because of tax laws, the way they work. Accounting principles and tax laws are not exactly the same. So one of the major things I have mentioned is the fact that you could have a situation whereby you have accrued, you've done accrual basis, tax law is saying cash basis. So when you have that mismatch, it is possible that the tax base upon which the government or the tax authority will estimate your tax liability is going to be different from the carrying amount in your books. However, you are aware that in the future, that tax consequences will still come to the full effect of your current carrying amount, meaning that it is just a matter of spreading it into the future, like the case of PPE that we looked at in the last class, whereby because of accounting, the difference between accounting depreciation and tax depreciation, there was overlapping between what is the tax base for now and what is the carrying amount of the PPE. But eventually we saw that at the end of the day, the full effects was just spread over a number of years. At the end of the day, it matched. So therefore, to match that in the current period, the future tax consequence, and now, we now do what is called the deferred tax. So the deferred tax is a consequence of the fact that the full tax effect will not happen in one single period. It will happen, it will overlay into the future. So therefore, you are making an estimate and making an accrual for it now, so that by the time it is now in full effect in the future, you have already provided for it. All right. So we said we could have a situation. What really leads to different taxes? Tax base is different from carrying amount. Let me look for our workings on that day. That's if I have not expanded that working for CR students. But let's see. I think I did, but let's use it. So let me stop sharing that and share OneNote. So, like I was saying, we say whenever we have a situation where tax base and carrying amount are different, we say we will have what is called temporary difference. And what is tax base? Tax base is really what the tax authority will attribute. It is what the tax authority will attribute to an asset or liability for the purpose of tax. That is what the tax base is. All right. So therefore, if you have a carrying amount of an asset or a liability and it is different from the tax base, then you are going to have a temporary difference. Now, we now said that temporary difference can either be taxable or it can be deductible. Now, if you have a carrying amount that is greater than the tax base, we said you are going to have a taxable temporary difference. And we said if the tax base is greater than the carrying amount, you are going to have a deductible temporary difference. And this is all highlighted in what we did in that class, all right? Okay, and then we went ahead to do some small tests of our understanding of what tax base is. By and large, what I said is this: to help us to know whether we are going to even have a temporary difference or not. At times, it's best to ask yourself, from what they have said, is there any future tax consequence? Will there be any future tax consequence? If there will be none, then don't worry yourself. Just equate the tax base to the carrying amount. That's what it means. Don't stress yourself as regards the technicality of what tax base is any longer. Just equate the carrying amount to the tax base, all right? Okay, now, we went on to say we could also have a deductible temporary difference, which means that as of now, we have a tax base that is greater than carrying amount, meaning that we are subjected to more tax now, but we have seen that in the future, as a result of this same transaction, we will have less tax to pay. Do you understand? We will have less tax to pay as a result of this same transaction in the current period. We will have less tax to pay in the future. So we are going to be deducting from our tax liability in the future. So they called it deductible temporary difference. Now, deductible temporary difference will usually lead to what is called deferred tax assets. When it is taxable, it will lead you to deferred tax liability. So deferred tax liability occurs when we have a taxable temporary difference. All right. However, when it comes to deferred tax assets, it is not only a deductible temporary difference that will lead you to deferred tax assets. You could also have the case where, I'm coming, deferred tax assets can be as a result of three things. Number one is what we just explained now, deductible temporary difference. Number two will be when you have unused tax losses, unused tax loss reliefs, unused tax losses relief carried forward. That means we still have, the law still permits us to make a deduction from our taxable profit as a result of losses that we made in previous years. All right. You could also have a deferred tax as a result of tax credits, unused tax credits. Maybe the law permits you to have withholding taxes that can spill into other periods. And then you are now in a particular year and you have unused withholding tax credit, for instance, in the previous year. And the law permits you to use those unused withholding tax credits to reduce your tax liability in the current period. So that would lead to what we call a deferred tax asset. By and large, having a deferred tax asset just simply means that you have such an opportunity to recover your assets by reducing your tax liability. How the deferred tax asset is recovered is that it will help you to reduce your future tax liability. Don't forget that we can also have current tax assets. If you have a current tax asset, it means right now you will use it in the current period. But if it is in the future, then we'll say a deferred tax asset. This one, anything deferred tax has to be because of the future. All right. Now let's leave all of this now and see what we can do as regarding our questions. All right. As regarding our questions. Where's this file? So I sent out an updated questions for cash flow. For those of us that attempted my assignment and I did not, I'm sorry, I just remembered again this evening. I'll try and make sure that I send it out. I just need to put it on Word and turn it to PDF. I don't want to send it the format it is right now. All right, let's look at okay, this is a CR question, but it's not too hard. It's quite easy. I feel like it's something that we can do. So let's start with it. I think we should start with it actually. All right. Are we together? Can everybody see my screen?
Not yet, not yet.
Not yet, we can't see it.
Oh, sorry. I need to stop. I already stopped sharing just for me to go to this one. All right, how about now? I think you should be able to see it now.
Yes, yes.
All right, good. All right. Number one question is a CR question from last two diets. And like I said, except for one of the requirements, I don't think that it's even not a requirement, it's a sub-requirement. I don't think it's a question that is too hard for us to understand the concept of it. Quite straightforward. Let's read. Below is the statement of financial position, extracts of Bamboo PLC, which has a number of subsidiaries in all the geopolitical zones of the country, and one foreign subsidiary, Baco Limited, located in the United States of America. All right. And then we have this draft statement of financial position as at October 31, 2023. Now we're told that Mr. Agbaje, the finance director of the Bamboo PLC, is in the process of preparing the financial draft of the financial statement, and the following issues relating to the treatment of different tax implications arose. Right, we're told number one, in terms of PPE, on November 1st, 2022, Bamboo PLC purchased an item of property, plant and equipment for 120 million naira, which qualified for a government capital grant of 20 million. The asset has a useful life of 5 years and is depreciated on a straight line basis. Capital allowance are restricted by the amount of grant by the Federal Inland Revenue Services. The company income tax laws specify a capital allowance rate of 25% per annum. Okay. Having read this, let me even see what is the requirement. The requirement say we should briefly explain and show necessary calculations, if any, of the different tax implications for each of the transaction in I to III above, 15 marks. All right, meaning that I'm going to have to treat them apart of each other. I can consider this on a standalone basis. All right, let's look at this all over again. We have been told that the cost of these assets, is how much? 120 million. However, it qualified for government capital grants. It qualified. One of the conditions to recognize grants is that you must know that of a sure you have qualified or you will qualify for the conditions to receive the grant. All right. Now, the standard IAS 20, in case you are still not understanding what I'm talking about, they said government capital grants. You should, of course, think of IAS 20. IAS 20 recommended two methods: the asset method, I think, and the income method as well. All right. So I'm just going to assume the asset method. All right. And it does not mean that if I do income method, it's still not the same effect. But to make it more straightforward, if I'm using the asset method, of course, I will say this grant should be deducted from this 20 million before I now go ahead and do my annual depreciation. All right. And the question already told me that the asset has a useful life of 5 years and is depreciated on a straight line basis. So this immediately tells me I'm going to divide this by 5 and I'll have 20 million depreciation each year. Now they say capital allowances are restricted by the amount of grant by Federal Inland Revenue Service. Now what this means is that government is saying, when I want to calculate my tax depreciation, I am not going to consider this 120 million. I will first of all limit this 120 million by the amount of grants that you have received, right? By the amount of grants that you have received. Okay. Let me share my full screen so that when I'm switching, you might be able to see what I'm doing as well. All right. Let me just use Excel. I think we are used to using Excel in this class. So I can come here and say cost is 120 million. Quite all right. I would just like to use 120. Grant was 20. Grant was 20. Therefore, the carrying amount of this asset is 120. Okay, sorry. I need to calculate depreciation. That will be our net cost. I can call this net cost because I'm using asset method. For the purpose of depreciation, it is this net cost I'm going to use. All right. They told me it is going to use 5 years. So I'm simply dividing this by 5. And my annual depreciation, I prefer to call it accounting depreciation, is this 20 million. All right. But now for the purpose of tax, the question says that government or the tax authority, FIRS, will restrict. They said it will restrict the capital allowance, meaning the tax depreciation. Capital allowance and tax depreciation mean exactly the same thing. All right, give me a second. All right, sorry. Now, we know that capital allowances are tax depreciation. So if they say they are going to restrict what they will consider for capital allowance by the amount inevitably saying is that we will not consider the cost to be 120. We will do the same thing you have done here. We will do it here now. We will also say net cost is 100 million. The only difference is that tax depreciation will be 25%. So this will be 25% multiplied by this 100. And then we have 25 here. Now, my carrying amount in this instance, carrying amount, of course, carrying amount, I'll be paying attention to, except we bought it at the end of 2022, and we are dealing with 2023. So therefore, there would have been 1 year depreciation. So I'll say this net cost minus the 1 year depreciation, and I have 80, right? My tax base, the base of the tax, also will be this same amount, but minus the tax depreciation this time. And that gave me how much? 75. So in this instance, carrying amount is greater than tax base. We said whenever your carrying amount is greater than tax base, it only means that the tax authority is subjecting a lower amount to tax now, but they will still subject the remaining over time in the future. So therefore, this should be a deferred tax, or let me even start by saying this should be a taxable temporary difference. A taxable temporary difference. Now, what is the tax rate? According to the question, what is the tax rate? They give us tax rates because that's also important. All right, if you come down here, you will see it. They say tax rate is 30%. I want to beg you, please, don't confuse tax rates with capital allowance rates. I don't know how I will explain this to people who have never written either tax at skills level and are not still writing it now, as of now, at professional level. Maybe you are not writing it yet. Let me repeat myself. The capital allowance rate, this 25,000, is going to be what the tax authority, this one here, is what the tax authority will consider when they want to determine the tax base of an item of PPE. It is different from the income tax rate of the company. The income tax rate will be given to you separately. They may be the same, but most time examiner will not give you the same rates. But my own is that just pay attention to the language of the examiner so that you are able to differentiate what the tax rate is from what the capital allowance rate is. So we have so determined it here. Tax rate is 30%. Therefore, our deferred tax liability, our deferred tax liability here is 1.5 million. All right, we have a deferred tax liability there. Let's look at the second one. The second one said fair value adjustment. But before I go on, do we understand this? My thought process is that it is straightforward, but do we understand?
Mr. Abiodun?
Yes, sir. Is it clear or not?
The arrangement in that spreadsheet is confusing.
All right, let's go back to it then. It's not clear. Okay, somebody said it's not clear. Let me close this one. Yes, I want to be there later. Somebody said it's not clear. Yeah, what is the arrangement that is not so clear to you? Yeah, let's see it. Would you prefer I bring all of this as workings, cut them
Yes.
out, and bring them down for you, and then I can take everything back up now? Is it clear like this? I'm coming up. Or is it that is it just arrangement, or there's something you need me to explain there? You can take this as our solution, and then we can take this as our workings. How did we get there? I'm with you.
Sorry, sir. That of the carrying amount of 80,000.
Okay.
It means that is what you derived after you calculated your annual depreciation, Abi.
Yes.
That will be
You
for 2 years, which is 40,000.
No. Okay, let me come again. Everybody, I want you to pay attention. Have we done IAS 20? Have we done IAS 20? Prudence, have you done IAS 20 with Mr. Washi?
No. Investment in property?
No.
No.
Investment property is IAS 40. Okay, maybe that's my first error. All right. But it's not a very tedious standard, so to say. But is there anybody, Mr. Latif, have you done IAS 20 in the past, or you've gone through it already?
Can you remind me the title of the IAS?
Okay, so IAS 20 is speaking to accounting for government grants and government assistance.
I read about it before.
Right, government grant. Anybody in this class that have done IAS 20 before?
Mr. Abiodun, sir.
I'm with you.
Let's put it straight, sir. The concept is that you see this your spreadsheet. It's different from our normal method that we are used to, whereby it will be on a normal page where we have calculate the depreciation, we will put brackets to indicate the loss, we have the calculation separately and some other things like that. So compared to look at this one, so you've not been, we don't know minus, we don't know loss. We just need maybe.
How about now? And then when I now want to do my carrying amount, I should now say carrying amount. Let me give you space here. So you would have preferred to see that net cost here like this. And then for me to say carrying amount is now this coming. Well, this is going to be minus. Is that what you're saying?
Thank you, sir.
So that this will simply be this carrying amount. Is that what you're saying?
Yes, sir.
All right. No, is it better now? So this one now, I can also say net cost. Net cost is this. and then I have this. Is it not even better we go back to our former first? And then I do tax depreciation. Yeah. So this can be minus this. And then I have this. And this will be my tax base. Is it clear like this?
I'm fine with this.
Okay. This is fine, everybody, right? He said this is worse. So should I use plain sheet for this one then? The question is way simpler than you are now making it look.
Maybe you should do it on a plain sheet.
Let's try plain sheet and see how it looks like.
Okay. You are the bosses. Anything you see. Okay, so this is what I'm trying to say. That we can say I carrying amount. All right, in million. And then we have the tax base as well. And then we can have tax rates. At 30%. And this will give us our deferred tax liability.
Temporal differences.
We have our temporal difference here. Taxable temporal difference. That will be here.
Yes.
All right. And then I can have my DTL, deferred tax liability. Yeah.
Thank you.
All right. Okay. So in terms of carrying amount, I said, first of all, the cost of the PPE was 120 million, quite all right. Now, when they say grant just means that you have received money from the government. And at times, when you receive grant from the government, it is tied to the purchase of an asset. Government may say, if you have so carried out a qualifying capital expenditure, all right, we are going to give you a grant to the tune of this amount, or there's going to be a basis of calculating what grant we are going to give you, meaning that government is relieving you of having taken on such capital expenditure. That can happen in a country. Now, should that happen, what will take place is this. You have the choice. Under IAS 20, you have the opportunity to deduct that grant, do an immediate deduction of that grant from the cost of the asset, which is what we have done, to deduct it from the cost of the asset.
Okay.
I'm sure you will soon do, we are still going to do IAS 20. Now, when you do this, it means that when you want to calculate depreciation, your depreciation will no longer be based on the original cost of the assets. It will now be based on the cost of the asset minus the grant. Do you understand?
Yes, sir. Yes, sir.
The standard gives room for another approach, which is the income approach. I'm not going to sweat on that one. When you get to class with Mr. She's going to really deal with that. In that approach, I will not deduct this 20 million from the cost. What I would rather do is I will go ahead and do, but you will see that it is the same net effect. I rather divide when I want to calculate my, what is it called, my depreciation, I will divide by 120, 5 years by 120. And that should give me how much? 24. But what I would do is that this 20 million, I have not recognized it. How am I going to recognize it? I will recognize it as a liability. You know, when you earn, when you have not earned an income and you receive it, what do? You take it as a deferred income, Abi? Yeah. So you take it to liability. So you take it to liability, divide by 5, 4 million. This 4 million, you will be charging it as income. You will take it to your P&L each year. So at the end of the day, you are taking minus 24 million as depreciation charge. You are taking plus 4 million every year. The net effect at the end of the day is still this 20 million each year, which is what you would have gotten if you divided 100 million by 5. So the straightforward approach, instead of having to go through all of this, is to say, let me deduct that grant from the cost of the item. And when I want to calculate my depreciation, I will calculate my depreciation based on the cost minus the grant. So at the end of the day, what you will now have is depreciation will now be equals to this 100 million divided by 5 equals 20 million. Now, carrying amount for 2023, right? Let me be sure, because I have assumed that it's 2023 this whole time. They said we purchased 1st November 2022. So by 31st October 2023, that's 1 full year. So my carrying amount should be 120 million minus 20 million, the depreciation of that 1 year. And then I have 100 million. So I can bring down 100 million here. What am I saying? The net cost now, we are not using 120 again. The net cost now is 100. 100, and this should give me 80 million. So that 80 million, I'm bringing it here. Right? So I can erase these ones. Don't worry. IAS 20 is a very straightforward standard.
No, it's okay. Fine now, Mr. Jordan.
Okay.
It's fine now.
All right, good. Now, we come down to tax base. For tax base, I said government too, we say, government has also said that they are going to restrict capital allowance to the capital grant that we had received, meaning that they don't want to calculate based on cost. They will also say, oh, you got capital grants. Let me just write grant. You got grant 20 million. At the end of the day, we have 100 million. So for year 2023, your tax depreciation will equals 25% of 100 million, which is equals to what? 25 million. Therefore, your tax base will be this 100 million minus 25 million, which gives us 75 million.
Okay.
So it is this 75 million that is your tax base. Immediately we come here, we see that carrying amount is greater than tax base. I said, whenever carrying amount is greater than tax base, then you have a taxable temporary difference. You can either cram that. I'm not a very big fan of cramming. It's common sense as well. It only means that in the future, your carrying amount, this 5 million difference will come to reflect in the future, and then it will be taxed in that future. So you have 5 million difference, carrying amount is greater than tax base, taxable temporary difference. So what is whenever there is taxable temporary difference, I say it's going to give birth to deferred tax liability. You will have a liability more to pay in the future as a result of this PPE. All right. And what will be the amount? You use the tax rate on the taxable temporary difference, and that will be equal to 30% times 5 million, and that's how we get 1.5 million. So that is that on the first one. Quite straightforward and easy. Go ahead, Mr. Latif.
Thank you, sir. I think there is confusion here, sir.
Okay.
Remember that it is only in accounting practice that we recognize depreciation. In tax principles, depreciation is not used. Rather, they call it capital allowance, IB?
Yes, absolutely.
So where you wrote tax depreciation 25%, it should be capital allowance 25% of 100 million. So that depreciation should be eliminated under the tax base.
Okay, thank you very much. Now, IAS 12, have you noticed? IAS 12 says tax depreciation.
Okay.
Go and check. IAS 12, the language of IAS 12 is not capital allowance. It is tax depreciation. And I'll tell you why. The reason for that is that they know. The standard is coming from the angle that is why the standard took its time to try and give some explanation or definition to those terminologies. Because you as an accountant, even though in writing this chartered accounting program, you are writing tax, we don't see you as a tax expert. Do you understand what I'm saying now? So what is the best way to convey capital allowance to an accountant who we want to assume has zero experience or zero knowledge of tax? It's impossible, but let's assume that the person does not have much knowledge of tax. We'll call it tax depreciation, meaning that this depreciation is calculated for tax basis. So it's a spread of the costs of the asset, but it will be carried out by the tax authority for the purpose of tax. So what differentiates it from what you as the accountant does is just that the tax authority is the one calculating it for the purpose of taxation. That's just it. All right. Thank you, Mr. Prudence. Go ahead. You wanted to say something?
No, I said this is glaring to me. I mean, this breakdown on this plain sheet, I think it's glaring.
Okay, it's much better for you now. All right. No, all right. Thank you. We'll do whichever one fits best according to what we are doing. All right. So we've used the whole of the only problem I have is the screen size. So we've used the whole of this page to analyze this and you have taken it in, it's fine. Let's go to the next one now. All right. The next one says fair value adjustment. All right. Fair value adjustment. But the issue now is, are you able to follow me? Are you able to follow me? Are you able to follow me? No, I can close
Okay, sir.
and quickly
I
come to
would
the
like
screen again.
I would
Go
like
ahead.
to ask. Okay, I would like to ask a question. Okay, so
Go
regarding
ahead.
this, as a business person, I have my assets and I have my business. On what basis or condition should the government now come, get engaged or involved in my business, and as such, support with the grants? What necessitates these grants?
Oh, this grant. Thank you very much. So grants will come in various forms. At times it can be cash, at times it can be tax holidays, meaning that to a particular amount, if you have tax liabilities, the government will waive. But there will always be conditions to it. I don't like to speak as to what I don't know and have the full details of. But what I heard of some time ago was a rumor some time ago that Dangote was repairing a road. I think it's a federal road in Lagos. And then I can't, like I said, I can't substantiate. The
That's true.
Nigerian government, the Nigerian government will give him tax holiday or something. They will always. So what the government does is that you are probably taking on a capital expenditure that most of the time, what will qualify for this is not only going to be something that benefits your business alone. It might be something that benefits the general public. For instance, Dangote refinery. That refinery is a very important economic step, not for Dangote alone, but for the whole of Nigeria. So if government looks at it from that direction, they can say, okay, we're going to give you a grant, or we are going to, one way or the other, participate in, maybe give equity contribution towards the building of that asset. Do you understand what I'm saying now? So it's
Yes.
not just that government just says, oh, we really have interest in your business per se like that. It's most times. The standard will not talk about that. The standard is just to give you guidance that when you have met the conditions and it is probable that you are going to receive that money, having met the condition, then you can go ahead and account for that grant like this. Because if there is no guidance as to this grant, when you get that grant, accountant A will treat like this, accountant B will treat like this. Do you understand? So you will now have a situation where the same amount of grant has been given, accounting wise, even when method is different, you will see that the net effect is the same thing. So the standard is just to give us guidance on that. Is that clear?
Yes, sir, it's clear. Thank you.
You're welcome. All right. Fair value. Let's look at the next one. We're told that fair value. Sorry. We're told that we have fair value adjustment. I would like someone to help with this one. It's quite straightforward. Let's pay attention to it. We're told on November 1, 2022, Bamboo PLC acquired a wholly owned subsidiary, Iroko Limited, for 100 million naira. That was when? That was at the beginning of the financial year. Now, on that date, the fair value of Iroko Limited net asset was 80 million, and the carrying amount was 70 million, which is also the tax base under income tax law. I say make I Let me read it again. On that date, the fair value of Iroco's limited net assets was 80 million naira and carrying amount was 70 million naira, which is also the tax base under income tax law. The difference between the fair value and book value of the net assets relates to an item of property, plant and equipment which Iroko Limited currently has no plan to sell. Which they currently have no plan to sell. All right. I want somebody to tell me what is the tax base. That's the simplest one here. What is the tax base of that item of PPE? But this one, I may not even need to go to whiteboard. I'll just do it for the sake of. So the question is staring at you. You can reread it. What is the tax base?
Somebody have answered you, sir.
How come me I have not seen it?
Look at the chat box. Aisha have responded.
Aisha, I can't see your response. Did you respond to Mr. Latif alone? 70 million. I can see it. I can see it. Just keep it for me. I can see it now. Now, 70 million is correct because immediately after they wrote 70 million, they told us which is also the tax base under income tax law. Now, the only play they are playing with you, yeah, because that's what they're actually doing. They're playing with you with something. Who can tell me what is the carrying amount? Let me see whether you already found out what they're playing with here. What is the carrying amount? Is the question. What is the carrying amount? $80 million. Very good. 80 million. Now, Aisha, please, can you tell us why it is 80 million so that everybody is carried along? Why is it 80 million? Why is it 80 million? Anybody? Even for the purpose of accounting, what we will consider is the fair value amount of the asset. Do you understand? What we will consider is the fair value amount of the asset. The company has just been bought over. In the identification of net asset value or the identifiable net asset of the company that has just been bought over, what we will look at is not the historical or carrying amount. What we will look at is the fair value of that asset. So beautiful. So it's very straightforward now. Carrying amount. And I like that it is you people that discovered it yourself so that you understand that this one is not so much of a big deal. 80 million, tax base, they were very straightforward. They told us tax base is 70 million. So we have a carrying amount is greater than tax base. This is a temporary, taxable temporary difference, rather. Taxable. Another reason I'm dealing with this with you guys is what if they decide to test this? They tested it 2 days ago, CR. It's not a very tough question. Eh?
Yeah. Go and sleep. What is your problem now?
30%. Therefore, our DTL, deferred tax liability, is this times this, giving us 3 million naira. All right. Let's go for the last one. The last one. I hope this one I don't need to do much explanation. The last one I may need to explain. I may just need to explain that last one. Let me go back to sharing my screen, the whole of it. Can you see my screen now? Well, I'm not sharing anything.
No, sir.
I don't see you with your Magaji's cap. Oh.
Just say you like the cow. All right, we can see it now, right? Now we're told Paco Limited. Forgive my pronunciation of Paco. Paco or Paco Limited, a wholly owned foreign subsidiary of Bamboo PLC, has undistributed post-acquisition profit of $5,000, which would give rise to additional tax payable of 4 million naira if remitted to Bamboo PLC. I want you to take your time and read this thing very well. As Paco Limited is relatively new and rapidly expanding company, Bamboo PLC intends to leave the earnings with Paco Limited for reinvestment. I want to ask you, read it carefully. Read it carefully and tell me if there is going to be a future tax consequence or not. Is it probable that there is going to be, think about it very well before you answer, because I will ask you why you are choosing your answer. Think about it very well. Is there a probable taxable or tax consequence in the future as a result of these events? In the current year, we have a foreign subsidiary that have made $5,000 profit. If they remit the money to us, then we will have a tax liability of 4 million naira. However, we have asked that company, don't worry, take this $5,000 as a reinvestment into the business. Now I'm asking you, is there a probable future tax consequence as a result of this transaction? Let me hear from you.
Can you repeat your question?
It's not my question. It's an ICAN question. So let me explain the question. I think you have the question. It's not me repeating the question. So let's assume Aisha PLC is a foreign subsidiary of Equity Professionals. We just started that company. And now Aisha PLC has made $5,000 in profit. All right. Now remember that company is wholly owned, meaning that Equity Professional own Aisha PLC 100%. All right. So therefore, they can decide to receive all of this $5,000, and they can decide not to receive it for Aisha PLC to retain that profit as a reinvestment into the business. Now, if Equity Professional decide to receive the amount now, the profit now, they will be liable to pay 4 million naira tax. That's the tax payable on that dividend. All right? That dividend from Aisha PLC will lead them to paying 4 million naira tax. However, Equity Professional have now chosen that, you know what? Management of Aisha PLC, please continue. Don't worry, don't send any money down to us. Don't send dividend to us. Take it as a reinvestment. The profit you have made, take it as a reinvestment into the business. I want to make life easy for you so that you don't go turning your head round and round. The simple question I'm asking is, first of all, ask yourself, with regards to this transaction, is it probable that there will be any tax consequence in the future? Your answer is supposed to be yes or no, and then you now back it up with reason.
Okay, I think it's yes.
There will be, all right. Why do you say yes?
Okay, because these 4 million is to be subjected to tax, but they are like defining it. Say, okay, we will not pay it now, reinvest it, and we'll pay it later, from my understanding. So they will still pay tax on this 4 million later, after maybe Paco has Aisha has invested and now brought. I don't know, but
right.
it's subjected to tax.
I just wanted to hear your view. Thank you very much. Do we have any differing opinion? You may agree with.
Yes,
Okay,
yes.
Do you have a different opinion, Mr. Latif?
No.
You don't have one. Somebody also was saying something. Was it Esther?
So I think he's right, because this is time value for money. So in the future, it becomes the deferred tax that Coco Limited is not liable to pay.
All right.
So it might even accumulate more, in the future. So they are
You said it might accumulate more in the future. I like that. I like that. But can it turn around and become a loss in the future as well? Are you sure this 4 million will come back when they come back next year? It can be more in the future, it can be less in the future. So it is not probable that this money will come back, this profit of 4 million because it will come back in the future. It is not probable. Do you agree, or you are still going to argue with me? Do you agree, or you are going to? The tax authority does not even know about this. It's not so. Get what we are dealing with here is not an asset, right? What we are dealing with here is not also a liability. It is dividend from a foreign subsidiary. It's why it is here anyway. Now, the line of thought you have there is the line of thought that every other person would have and say, but you see, that bottom line that you have this year, once in the form of dividend, I'm supposed to receive an amount, and I did not receive it. Even I'm trying to stray away from entering, was it your class? Okay, I think it was CR class. I made that error. What was the error I made was I entered into a lot of tax discussion. IAS 12 is not about tax conversation. Whether I know tax or I don't know tax. It's not really about that. We need help. Sorry. So we need help. If I have the understanding of taxation, it will help for me to have some background. But every question will tell you what the tax consequence is or give you an idea. The reason they are doing that is so that you don't have to figure out what is the tax, right? You don't have to figure that out. Now, in the real sense, the part where they told you, look at it, they did not say They did not tell you that it is cash basis, but they have already implied it. Look at what they said there. They said it would give rise to additional tax payable of 4 million naira if remitted, meaning that it is until Bamboo PLC receives that money. If they have not received that money, it will not make them liable to any tax. Number one. Number two is now that you now consider that future. The amount that we are referring to here, is it probable? If you look at the way we did carrying amount of PPE, the tax base, you will discover that in the last class, let me see. That last class, somebody said they did not understand that calculation. This would have been the perfect opportunity for me to share something there. Okay, you are seeing my screen now. I'm currently looking at an Excel. Are you seeing my screen, everybody?
Yes.
All right.
Yes.
So you will notice that I said something in that last class. Look at what we did that class as regard. Look at tax depreciation over 4 years. You don't finish, Abi. But your accounting depreciation will spread over 5 years, right? We now looked at the cumulative difference. Each year, there was 2,500 difference between the capital allowance and the accounting depreciation. But when you got to the 5th year, what did you notice? The tax authority will say, I am not giving you any capital allowance again. You have exhausted your capital allowance. Meanwhile, you have a accounting depreciation. All along, what they have been doing is, look at your taxable profits. What they have been doing is they have been adding back your tax depreciation and deducting a greater amount, 12.5. Abi? That's what they have been doing all along. When they get to that 5th year, what will they do? They will say your tax depreciation will be added back as part of the taxable income. But there will be nothing for them to deduct as capital allowance in that 5th year. So, at the end of the day, all of these temporary difference in year 1 to year 4, 25, 25, 25, is 10,000. Abi, the temporary difference in the 5th year is minus 10,000. What am I trying to tell you is that we can calculate from now what the tax consequence is. We know it. I can speak as to what is the tax base, and I can speak as to what is going to be the temporary difference in amount, not just in that, oh, is there a tax consequence or not? It's also that I can determine or I can estimate the amount. But in the sake of, in the case of this, it's a profit, a bottom line. So if they own it fully, they can decide, even in the following year, they can decide that, you know what, continue to retain that profit for another 5 years. It is the day that they receive dividend that the government will take that dividend as taxable income. That is not a problem. You will say, maybe they will get that profit in the future. And that means that there's a future tax consequence. All right. The question will now be, is it probable the amount of the tax? Is it probable? If it's not probable, then therefore, don't worry, there is no deferred tax in the future. It's the same idea when, was it your class? When we talk about deferred tax assets too, let me quickly use this opportunity to say this. If at all it comes out in your exam, it can be inferred in one way or the other. This is it. If you have a deferred tax asset, but you are not sure, are you getting my point? You are not sure that the company will make or will realize taxable profits in the future that you'll be able to recover such assets against. The standards say don't bother to say you want to recognize that asset. It is still a matter of probability and estimation. In this case, we can estimate what our asset is. What we cannot speak to is if it is probable that we would have earned enough taxable profit in the following years, so much so that we'll be able to recover this asset. Do you understand what I'm saying? It's like government is saying you have made a loss of 500,000. So I give you 3 years. In the next 3 years, when you make taxable profit, and I'm supposed to, when your liability, for instance, is 200,000, you will say, I have tax losses that I made in year 2003. Government will now say, oh, 2004, you made profit, but you made profit and there's a taxable, there's a tax liability of 200,000. Okay, you can use your losses in the past to recover this one, meaning that we will say your tax loss relief 200,000. You will still have a tax loss relief to carry forward to the tune of how much? 300,000. Abi? Now, when you make another profit, again, we'll use it against that profit to reduce your tax liability. That is the case of a company that it is probable that they will be making taxable profits in the following years. They are going to be making profits. But look at a company that has a record of making losses in the last 3 years. If I am an auditor, I'll be looking at you. How do you want to prove to me that all the losses you have been making, that you still want to go ahead in the current year and recognize as a deferred tax asset? How am I sure that you will make profit in the following year to recover these losses? I don't know if you understand what I'm saying. The amount of the tax loss is estimatable. We can estimate it in this instance. But is it probable that we will make profit such that we'll be able to deduct the tax relief from? It is not. So in such an instance, the standard gave us guidance and said, you know what, don't worry yourself. Don't worry yourself to recognize assets. I have said it in this class. Assets, what is standard? If you look at the spirit of IFRS, the spirit of IFRS is that whatever you want to recognize as assets must be something that you will be able to recover the economic benefits. Whichever way that economic benefit will flow to you, you must be able to get it back, get that economic benefit. If not, don't worry. Then impair whatever you have had before in your books. Bring it down. It's the same thing that IFRS 9 is saying. It's the same thing that IAS 38 is saying on goodwill. It's the same thing that IAS 2 inventory is saying. You will see that you will be writing down the value of the asset to an amount that is realizable or recoverable. In that same manner too, if I apply it to this one, we can say, yes, it is probable in the future. I intentionally ask you if it is probable, because I know you say they can make profits in the future. Yes, they can. But can we estimate how much they will come back with in the following year as dividend? Can we estimate it? We really cannot, because that reinvestment can lead to a loss. It can lead to more profit. It can lead to same profit, but we cannot say for sure. We cannot reliably estimate. So all those reliable estimates, all those things that you see that they say for each standard, if you look at the standard holistically, you will see that it's the same concept you are doing over and over and over again. It's just that the way it applies to each standard may be slightly different. When you do impairment in IFRS 9, you call it expected credit loss. When you do it in IAS 2, you say you are comparing the net realizable value and the cost. And then you are writing down the value of the inventory to its net realizable value. It is still the same thing as impairment that you are doing in IAS 36. The only difference is that the judgment of IAS 36 impairment is different from that of IAS 2 because of the asset you are dealing with. It's as simple as that. So, is it clear, everybody? I know I've had a long explanation just so that I'm bringing you up to speed as to the fact that these things are interwoven. But is it clear as regards why we are saying there will be no deferred tax in this case? Madam Aisha, is it clear?
No,
No.
I'm even a bit more confused.
Mr. Latif, is it clear?
Mr. Abiodun, I'm fine with the solution. Let us move on.
Hey, no. We will not do that. Prudence, is it clear?
You must
Well,
not know everything in class.
it's a yes and it's a no, sir.
Okay. Let me keep it short. So I will write like this. Let me use the Excel to write it out for you. Why are we not recognizing a deferred tax liability? It's like this. It is not reliable. We cannot, let me put it that way, we cannot reliably estimate the amount, the future, let me put it that way, the future amount of dividend receivable from, what's the name of that company? Baco Limited. Let's keep it short like this. We cannot reliably estimate it. And I believe that this one should be easy. The reason we cannot do that is because, like I said, when you reinvest your profit in your business, the question will be, Prudence was answering. I was waiting for her to conclude. But in her explanation, she now said it could be more. If it could be more, that's exactly where I'm going. If it could be more, then it could also be less. It means that we cannot reliably estimate. All of these ones I did, I went here, I was explaining, all I'm trying to show you is the same statement here. That in this instance, we can reliably estimate the future tax. In this ones that we have done too, where we said, there's government grant and all of that. What is common is that we can, but here, all right, can you hear me?
Yes,
Let's
sir.
move on. Let's move on. All right. Now, they now said we have done that. State briefly explain and show necessary calculation if any of the deferred tax.
Sir, share your
screen. I should share my what?
screen.
Oh, I've forgotten that they threw me out. Mr. Latif threw me out.
I say you no get power.
All right. There's a show the deferred tax effect on the statement of financial position. So what they are saying here is, all I'm going to do is to come here. We add additional tax, deferred tax liability of 1.5 million plus 3 million. If I add that to this value, what I'm going to have will be 4.5 plus this. That should lead to about 190.5. So that's what they are saying you should do. Now the other leg for this is clearly an asset. It does not affect this one. I can find it in the asset side. So it's a deferred tax asset. It's clearly an asset. All right. So you are to debit in those two instances. What you will do is to debit your deferred tax expense or your P&L, and then you credit your deferred tax liability. So if what I'm doing now is credit, the debit is also be P&L. And I always say the representation of P&L on financial position is your retained earnings. So I'll come here and say minus 1.5 million minus 3 million. If I take away 4.5 from here, I should have 615.5. Yeah. I should have 615.5. All right. So that is exactly what's going to happen there. And then you just return it back to them. So it's by and large a simple question, except for the third one. And that third one, a lot of people will do gymnastics only to discover that there is no. So pay attention to this. Pay attention to this. When it is profits we are talking about of another company, and a company is supposed to receive dividend. Dividend by nature, there are a lot of reasons why that thing is even. Dividend by nature okay, the fact that we are even discussing it with certainty is because it's wholly owned. What if it was partially owned? Whereby you don't even have controlling rights, for instance. You don't even have controlling rights. The company may decide not to share profits. What will you do about it? The company may decide not to share profits. If it was an associate investment, the fact that you are saying, oh, there is dividend that is receivable from associates does not mean that your tax authority will pay attention to that. What they will pay attention to in this very instance is when you have received that dividend. They won't pay attention to any other thing or that. So whenever that happens, you will always have permanent difference. It's permanent difference you have, not temporary difference. It will not be considered at all. All right, let's move on. What's the time? 10:25. I said it to be a short class. All right. In this instance, we are told of scalable. This is FR. Let's see if we can, if you don't drag me back too much, I think we should be able to finish this one. It's a very short question too. So permit me, can I go ahead? The answer is yes, right? Oh, good. Now, we're told Skelewu Nigeria Limited owns the following item of PP as at 31st December 2011. We have P&M, we have land, and then we have office buildings. Additional piece of information are, number one, plant and machinery are depreciated on a straight line basis over 5 years. The plant and machinery was acquired on 1st January 2011. All right. Land is not depreciated at all. All right. Buildings are depreciated on a straight line basis over 25 years. And depreciation on office building is not deductible for tax purposes for the plant and machinery. I repeat again, this office building, whatever depreciation is not deductible for tax purposes, but for the plant and machinery, tax deductible is granted over a 3 years period in the following ratio percent of cost consecutively. All right. Now we're told the accounting profit before tax amounted to this 15 million for the financial year 2012 and 20 million for the year 2013. These figures include non-taxable revenue of 4 million in year 2012 and 5 million in year 2013. All right. Skelewu had a tax loss on 31st December 2011 of 12.5 million. And the tax rate for year 2011 was 35%, years 2012 and 2013. We have to pick this one piece by piece. Now they say in accordance with IAS 12 on income taxes, differentiate between current tax and deferred tax. Okay, that one is for you, not for me. Sorry. And then again, they said, prepare the deferred tax account for the year ended 31st December 2013. All right. They also said we should advise the directors of Skelewu Nigeria Limited on reasons why it is necessary to recognize or make provision for deferred tax in companies' financial statement. All right. Okay, some things I can already see that I want to quickly point out. Okay, we have been told here, more or less what I see here is a situation where all of our focus will likely be on plant and machinery. Why? Because we have been told that for buildings, depreciation on office building is not deductible for tax purposes. It's not deductible for tax, meaning that whatever you have as your carrying amount will also be what they are going to tax. They are not offering you any, what is it called now? They are not offering you any capital allowance. All right. Also, we're told that for tax purposes, but for plant and machinery, tax deductible is granted over a 3 years period. And they gave us the percentage. They said this percentage will be applied on cost consecutively. So in the first year, it will be 50%. The next year, it will be 30. The following year, it will be 20. All right. Okay, let's go. I hope that along the line, this is 10:31. By 11, we should be done. All right. I'm looking at the best way possible. Let's see how it goes.
We must finish the question this night.
What did you say?
We must finish it this night.
I like that passion. I like that passion. Passion. All right. I'm looking for a way to make it faster. I think I did. I want to check if it's one of the questions I solved for, what was it called now? The CR students. If I can just bring it on board before we persist it. So if we pay attention to that question, I read a part where they already made mention of it themselves, that for the purpose of tax, you will see that the only thing they gave us tax allowances for was just plant and machinery. All right. So we'll need to do a calculation of what is the depreciation. First of all, on plant and machinery, the accounting depreciation that will be the cost divided by the useful life, straight line basis, Abi. And the cost was how much? They said we purchased 1st January 2011. All right. Cost was 45,000. Useful life was how many years? 5 years. So therefore, for each year, we should charge 9,000 naira per annum. For the purpose of tax depreciation, the question says that it will be 50, 30, 20 of costs, Abi. So therefore, first year, 45,000 times 50%. This will give me 22,500. All right. Second year, it should be 45,000 multiplied by 30%. That's exactly what they are saying. They said of cost in the consecutive year. So 50 first year, 30 second year. Now 30%, 45 times 3. That's 135. So this should be 13,500.
Yes.
And in the third year, times 20%, 45 times 20 is like 90 or something. So that should be like 9,000. All right.
Mm-hmm.
So now what I need to do is to compare for each year. I'm simply saying to myself, what is the cost? What is the depreciation? So that I can have my tax base, the tax depreciation. What is the cost? Sorry, this space may not be enough.
Okay.
Let me find a way to manage. So we can have cost like this. Okay, let me put tax base here. Temporary difference. Of course, we'll determine whether it's taxable or not. And then I can have my deferred tax like this. I think this is quite straightforward.
Mm-hmm.
I want to believe so. So, 1st of January 2011, would have had cost 45,000. Abi? Now,
Yes,
your
sir.
depreciation, accounting depreciation will be 9,000. Okay? Cost is still 45,000. Accounting depreciation in the first year is 22,500. No be so? Now, carrying amount. Okay, can be carrying amount there and still be tax based there. So let me just find the resulting amount. This will give birth to 36,000 and this will give rise to 22,500. All right. You also discover that as of this level, they are the same, no problem. But when you come down here, tax depreciation is 9,000. I mean, accounting depreciation is 9,000. Tax depreciation is 22,500. That difference will give birth to a taxable temporary difference, right?
Yes, sir.
All right.
Because 36,000 is greater than 22,500.
All right. So that difference is how much? And 2 minus 9, 13. So
13,500.
thank you. 13,500. Now, the implication of 13,500. What's the tax rate? According to the question, what's the tax rate? Abi, they did not give us. Okay, good. They said 2011 tax rate is 35%. So if you do 0.35 multiplied by 13,500, 4,725. Is it clear up to this point? This is no difference from what we have been doing before. Is it clear?
Yes, sir.
All right. Now, remember that they changed the tax rate in 2012. The last part of the last additional information says Skelewu Nigeria Limited had a loss on 31st December 2011 of 12.5 million. The tax rate for year 2011 was 35% and 30% for each of 2012 and 2013. The reason I'm reading this is that in 2011, this will be the end of 2011, 31st January, December is the financial year end, all right? But let me erase this part too, small, so I can have some space there. So this will be 31 December 2011, all right? Now, I'll come back to this tax laws. There's a tax laws. I'm looking for a clause there. Okay. All right. So for year 2012, what we are going to have as our carrying amount will now be that 36 million. Abi?
Yes,
so we'll
sir.
say depreciation again. In 2012, you deduct 9,000 and then you deduct 13.5. Somebody will say, where did I see 13.5? This is where I'm seeing the 13.5. The second year tax depreciation is simply 13.5. All right. This will give birth to 36 minus 9.
4,500.
Yeah.
Okay. The difference is
This one is 9,000. Of course, that's what is left. However, the difference between these two is the 4,500 that you have mentioned. All right. Now, in this case as well, the carrying amount, this will be 31st December 2012. The carrying amount is 27,000. Tax base is 9,000, meaning that we are going to have a taxable temporary difference. And the taxable temporary difference is going to be, how much is that? 4.5, Abi?
Yes, sir.
0.3 times 4,500, 1,350. So we have here 1,350. Now, in case you are wondering what I was going back to check, what was I going back to check? I was going back to check if the standard, if the question made mention of whether we are going to be able to recoup any tax losses or not. I'm not going to assume for them. I have seen the solution, that's what they did. But I will consider it an assumption. I have told you, IAS 12 does not assume that you know tax. And that is why every question tells you the tax implication, the tax consequence. What are you supposed to do? If not, they should not need to tell us. We'll just use our knowledge of tax and do it. All right. So that is why I'm not going to make any adjustment for the rate for any tax losses or rate change, because the change rate. Now, if it were to be a real life situation, I would have made that adjustment. But nothing in the question warrants me making that. All right. In the current year as well, there's a 9,000 difference. And the third year, the same amount, 9,000. And now December 31 December 2030 now. I will have here 18,000 difference, which means I'm still going to continue to depreciate. But as for tax authority, they will say, Ogbeni, we are done with you.
Mm-hmm.
And in that current year, I would have no temporary difference, not to talk of taxable temporary difference. So at the end of the day, what I would have is, so you see this cumulative temporary difference of 18,000. In the next 2 years, they will charge 9,000 in 2014. This is what I was trying to explain, but you guys seem not to be getting it. In 2014, they will do 9,000 accounting depreciation. Abi, in 2015, they will do 9,000. But at that point in time, there will be no tax relief. There will be no tax allowance. There is no tax depreciation. So the total amount you are going to have, let me just show you. In the following year now, you will have 9,000. It's not part of our question. They didn't ask us to do it. I know. The tax base, when we want to calculate tax base, there will be nothing because we are done. But here, you will have temporary difference of 9,000. Abi, the same thing will happen again. And that is how you are going to deduct this 18,000 and to come to me. So that at the end of the day, at the end of the 5th year, you would have matched all of those years where you were charged a lower amount of tax. All right. Okay, so definitely this is what I'm going to have for my deferred tax liability. Is as straightforward as that? There's no need for any elaborate calculation. But I can see what they did here. It was quite elaborate. They did a lot of stuff. Too many stuff. And then the question also did not ask us to calculate current tax. It says you should do the deferred tax account. And that's that. That's the deferred tax account. The only thing is this. In the 1st year, I would debit my current tax expense. Or let me say, so I don't confuse people. Let me call it income tax expense. The one that shows up in your P&L. This amount, 4,725. And I'll credit DTL. How much? 4,725. In the 2nd year, I will not carry everything like this. What I will say is debit income tax expense movement. This is the movement, 1,350. And then I'll credit DTL, 1,350. This is the most I will do to answer this question. That's the most. For me to just add the accounting treatment in terms of the double entry. That is the most that I'm going to do. All right. Okay. Now, 12 questions solved. In terms of reasons why you should do your recognize or provide for tax, deferred tax, we have said it is for matching. You are trying to match the future tax consequences as a result of current year transactions with how much you would have to pay or how much you will be able to recover from your tax liability in the future. That's the primary purpose. That's the primary purpose. Also, you may now add your own JARA to it. What will be my own JARA is to say that, okay, you want to have a closer estimate. You want to reduce the gap as much as possible so that you can have a closer estimation of what your tax liability will be in the future and the provisions that you are making for such liabilities. So for matching is the first concept. Mr. Latif, go ahead.
Thank you, sir. Based on this calculation you have on the screen, sir.
All right.
Okay. If you look at that accounting base as at 31st December 2013,
okay,
we still have a carrying amount of 18,000.
Oh, absolutely.
So it means that possibly if the question goes beyond 213, it means that 214 will equally have depreciation of 9,000.
Yes.
And then 215 will equally have depreciation of 9,000.
Absolutely.
Okay. But for the tax base, for the tax base, sir,
there's nothing.
Nothing left again after that.
There is nothing.
So if can you hear me, sir?
I can hear you.
Okay, if we are to go for that, it means that at 214 and 215, the carrying amount will be the accounting base will be greater than the tax base.
The carrying amount will be greater than the tax base, and then you are going to have the taxable temporary difference.
Okay,
do you understand?
Agreed. I will continue to apply that tax rate.
Yes, it's the tax rate you're applying, the 30%. You apply it on it. Okay. That's what you will do. Any other question, my people? This is your class, eh? People don't run away. Or is it network?
Small play. Network again. Mr. Ahmed, I've been trying to log in since the start of the class.
Yeah, because I was about to say that me and my own network used to do balabulu. Did not do balabulu. All right, thank you very much, guys. As regards the other questions, one of them is a CR question. I'm not sure if I want to stress myself on that one, but it's an interesting question, so I don't really mind. It has an element of IFRS 2 in it. Yeah, sorry, Madam Perry. It has an element of IFRS 2 in it, share-based payments, but it is still in your syllabus anyway, even though that is what they asked. But it's not too hard. It's also easy. But I will encourage you to go ahead and look at, what's that other question that looks like this one? This question 3. What's the name of the question? Question 3. Yemnike Nigeria Limited. Go and look at that question.
Sir, what?
It's also not.
Question 3, sir.
Yemnike.
Yem?
Yes, question 3.
YM.
Yemnike. YEMNIKE. Yemnike.
Okay.
All right. Just look at it. As for question 4. I don't know. We can do it. I don't know. No knowledge is wasted. Just to ensure that the point is driven over the stretch. Is just how many times you are able to meet is the bottleneck. However, between now and today is 22nd, on Friday, unfailingly by God's special grace, we'll meet together with what is it called? CR students and solve questions to round up on IAS 33. IAS 33 is quite straightforward. It's to do diluted and basic and diluted. We'll find our way around it. Then the next class, which I'm going to have with you, we'll do IAS 10. IAS 10 has maybe 1 or 2 small questions. The question said now part of question is not like it is the full-fledged question. So we'll look at that. IAS 10 is not so much of a problem. It's just
what's the title?
IAS 10 is events after reporting date.
Okay.
So just for us to know what events are adjusting events and which events are non-adjusting. That's exactly what they will bring to you if that is set IAS 10 to see how you are going to treat it. So if something is a non-adjusting event, most times it's disclosure required. They may ask you what are the disclosure requirements, or they may ask you how would you go about treating an adjusting event, and it's not so hard as well. So that may be the half of the class. And then if time permits, we go to IAS 37. If time does not permit, we'll reschedule. We'll have to find a way to meet and discuss IAS 37. Very important standard.
So please, I have a question.
Please go ahead.
Okay. So this is regarding, sorry, it's not on income tax. It's regarding group cash flow. So I would like to know, is it like an introduction on this skills level, or I can just try it last diet? Or because if something
they used to, in my experience lecturing ICAN, I have now come to a point where I'm asking myself, I'm asking my IAS 37, not 27, 37. I'm asking myself at times why they do what they do. I've had this issue before, and I said to my students, they will not make that mistake again.
Okay.
And then they turned me to a liar about 3 diets afterwards. They turned me to a liar. And they did such. It was not FR, it was another paper. It was a foundation paper. I think it was MI. I was telling them accounting, IFRS allows only 2 inventory valuation methods. So in their inventory valuation preparation, they should focus on FIFO and weighted average method. Only for ICAN to set me. I said, no, don't be worried. It must have been a mistake, blah, blah, blah. 3 days later, they set it. Now, and that is the reason why I am hoping that we can find time and do that question. But what have I seen in the question? I have looked at it, and I have seen that the very elements of group cash flow that makes it group cash flow and untestable for skills level were not really tested in that question. The only thing was the cash flow for acquisition of the subsidiary and the fact that NCI received dividend. That was all. And those are direct cash flow movements. That was the only thing. So we may just have to look at it. I'm hoping that it will be permitted of me, even if it is in the first week of May, to have maybe 2 or 3 classes with you. At least other lecturers will have finished by then. And then maybe I can just get exceptional approval to continue with you guys. Maybe take 1 or 2 classes, then I set the. And those classes are not for you to come and lecture. It's just for us to talk, solve those questions, and then move on from it. All right. Other than that, I wish you the best in your exams. What have I realized? I'm calling Mr. Light. What have I realized is that you're likely going to set standard. So I was telling the CR students, it's better for you to be able to write out all the standards and ask yourself, what do I know in this one? What do I know in this one? That may wake you up to quickly go and check out. You must ensure that as many as the standards that is testable at this level, you are able to say, at least if they say IAS 16, I know that, oh, these are the methods. Oh, this is the way they recognize it. Do you understand? If they mention, IAS 10, they are referring to adjusting events, just adjusting events. This is what the standard covers. I may not know everything inside that. It may be impossible, sir, for me to know everything inside that standard. But at least when I get to the exam, because I have some foundational knowledge on all of them, it is likely that I will scale through. Very likely that I will scale through. All right, Mr. Latif, please go ahead.
I'm just shocked or surprised that ICAN will be coming up with questions on topics that are out of syllabus. And no, let me be sincere.
To be sincere, it infuriated me when I saw it. Because whether it was you, I don't know who it was, somebody in this class had mentioned it. And I remember I said, it is impossible. They cannot set it. When I saw the question, I said, no. What is this? How can you ask skilled students to do consolidated cash flow? It does not make any sense whatsoever. Even though when I later looked at the question yesterday, I said that, okay, the elements of those questions were not as difficult as the one you would have done in CR. But at the same time, it does not make any sense. Because it's just going to rattle whoever is writing the exam, and the person feels like, we never did this one. Some people even curse their lecturer and say, this man no teach us. Yellow boy no teach us this thing. Why come? I know the good thing about students is that even if you are a bad lecturer, I have seen seasons where I know that, okay, I could have done better. And at times, I'll tell you, at times those diets, it will just be the little things I mentioned, but the little things I was able to do. Those are the things they will test. And that's how bad lecturer becomes good lecturer. Actually, have some diets, they will set around what you taught, but they will go to corners that you didn't go. And their students will be like, you can imagine, they taught us, but they don't teach us this one. They taught us. So it can be like that. But by and large, I'm praying that being the final diet for this syllabus, I don't know, something tells me it will not be as cumbersome as the other ones, because it is going to be their own headache. All the transitioning that has to take place between the next diet and the upper diet. Because most likely, by the third diet, nobody wants to hear about you want to transition. Oh, am I to do FM or am I not to do all those stories? So I expect it to be that kind of diet where people should be able to. The next diet is going to be brutal. But this one, I have a feeling it will be easier. Thank you, guys. I'll see you on Friday.
You're welcome.
Thank you, sir.